How's it, guys? Welcome back to FX Rhapsody. Today we're going to be doing analysis on two currency pairs. It's going to be the British pound, Japanese yen, and then also the British pound, US dollar. Before we hit the charts, you can go visit my website. It's on the bottom left corner over here. The link is in the description, where you will find previous analysis, previous strategies, lots of things that you can use in your trading career. For those of you that's getting started into trading, go visit my website. There's some nice video links or categories that you can click on where you can get started, where I tell you everything about your trading and what you need to know. Also, we're doing top-down analysis every weekend, so and we're using the CO3 reports just for reference on higher time frames and just to get a feel for what the market is doing on a higher time frame. So go download that COD report for free. And then also preferred brokers. These guys are brilliant. You know, when you trade and when you are a trader, you need a reliable broker behind your side. And these guys are one of the best around. So please go check them out. Okay, so let us hit the chart. So between these two currency pairs that I'm going to do analysis on, you know, you could have caught plus minus 600 pips, if not more, during the course of this week that just passed. And when we get to lower time frames, I will show you exactly, you know, where you could have entered and exited and all those kind of things. But we're starting out on the British pound, Japanese yen, and like we always do, doing top-down analysis. We're doing it from the daily and then moving down to the hourly. So on the daily time frame, what we can see is we can see some nice liquidity or a high that was been taken out, okay, right about there. So you can see price going up, tapping into that high. The liquidity was lying on top there, and then price just retracing back. Now, we always know that there's a reason for retracements and all that kind of thing. So this reason was this fair value gap, okay? This fair value gap, this imbalance in the market that was created. So you could see price going up, going into the liquidity that was lying on the top here, okay, that was created, and then price just retracing back into that fair value gap and then retracting a little bit, okay, towards the last, you know, the last section of the day. So as you can see, you know, just tapping into that that fair value gap, and those gaps always gets hunted, all right? That's just a fact. Price action does that. It always gets hunted. It's just a matter of time when it happens and all those kind of things. So over here, you can see as well, most of the week, price was just in this consolidation phase, in this ranging phase. Okay, I'm just going to draw this little block over here. As you can see, just price just in that area, and then towards the last section of the week on Friday, price just, you know, pushing through, like I said before, just tapping that liquidity that was lying at the bottom here, as you can see over there, and then retracing back again. So where this price going to go from here? Is it going to retrace back over here, you know, into that block area? Is it going to carry on downwards? You know, we will have to see what the market does this week. Let us look at the lower time frame and see what happened this week, where you could have entered, because like I said, we use the higher time frames. Okay, there's different traders. You get swing traders and intraday traders. Me, I'm more of an intraday trader. So focusing on the lower time frames especially. So on the lower time frame, what we can see is after every analysis that I do this, you know, section in the market. That's where price basically ended on last week, and then I just focus on that area and where price is gonna, you know, when price breaks above it or below it, we just react to what the market gives us, okay, and then excuse me, we trade accordingly. So as we can see, price just breaking above that area and going to the top here, and then started doing its thing. So where could you have entered? So the first entry in the market would have been after this high was formed. There was a low that was created over here, and then a retracement. And what we always do is, I'm just gonna zoom up a bit. So we have a Fibonacci from this low. We take your Fibonacci tool from this low to from that high to that low. So you have a swing high that was created, then price came down, created a swing low, and it made a retracement. Okay, so this is what we always talk about every weekend. So that's the area that you focus on, between the 62 and the 79% area. And as we can see, price going into that area and then dropping. All right, so that's a nice little sell. That's your first little entry that you could have taken. Okay, so that is already, let's call it a 170, almost 200 pip drop that it made. If you missed that entry, just going to take this out. If you missed that entry, you could have had your second one. Second one being this high that was created, the swing high, to that swing low. Okay, and you zoom, or you just, I'm just going to take it to the side a bit. So you have another entry, swing high, swing low, retracement, again to your area between the 62 and 79%. And then we had price dropping once again. So let's say you entered there, price dropped slightly, just over 130 pips. Okay, but again, it was just consolidating the whole time over here, and eventually it started dropping dramatically. So you could have just hung on to your trades, okay, so not climbing out of them, or you could have had a nice little entry. Let's do this. So you have a swing high at the top there, and then you have a swing low. I'm just going to show you this. You have a swing low, going up, going down, going up again. So I'm taking this very swing low at the bottom here. Okay, so you have a swing high, you have a swing low retracement to that area. And if you drag it across, then you could have had your Fibonacci just in, you know, either way. You could have hold it up until here, price just retracing every time, retracing back to that 62 area. So again, look at that. And eventually price going up, going down, going up, right about there. Okay, and as you can see, price dropping from there and made a nice drop. So where's your exit? Okay, if you had other entries, you could have had your first little entry, kept it there, your second entry, kept it there, your third entry. Where's your exit points? Okay, so if you go to the left here and you zoom in a little bit, you could see market opened with a nice little gap in the market. Those gaps you must never throw away, because those gaps are always areas that the market is going to get drawn towards. So I'm just making it to the side, and as you can see, eventually price hitting that area. So that would have been a nice exit point. So if you entered either from here, the second entry, or the third entry, let's just hold it from the first one. Okay, you would have gone down, and that's your exit point. That's already, it's over 300 pips that you could have caught just holding on to this sell, the first one. If you held the second one, it would have been a little bit less. Okay, but that would have been your exit area, right? So always look out for those areas in the market. Look out for those gaps in the market that get formed. Fair value gaps as well. Those are your exit points. Okay, it's not just an entry. You could have had a fair value gap at the bottom and then a fair value gap at the top. Price gets formed, or entry gets formed, and then price gets drawn to the fair value gaps at the bottom. But I'll show you that in a later stage. But yeah, that would have been a nice little entry. Like I said, 300 odd pips on that currency pair. Let's just look at the COT reports quickly. We're going to look at the British pound. British pound is up and down. Okay, it is currently up and down. You have the previous week, shorts being closed, longs being open. This week, longs being closed, shorts being open. So there is that consolidating phase in the market, basically. Japanese yen, let's have a look there. Japanese yen, like we expected, and I talked about it last weekend as well, it is just getting weaker again. So we get a lot of shorts being opened in the market, a little bit of longs, but obviously a lot more shorts, pushing that negative or that net position deeper into the negative. So that meaning that the Japanese yen is definitely getting weaker, all right? So let us move on to our next currency pair. Don't want to do too much of a long video today. We are looking at the British pound. Let's just start off on the daily. British pound, US dollar. Okay, so I'm just zooming in a little bit so we can see what happened. Starting again on the daily time frame. Now, just the reason I'm starting on the daily time frame is just to get a feel of the market, just to see where the price is going. Like I said, I'm focusing more on intraday trading. That's where most of the entries happen, most of the pips happen. I mean, it just feels, like I said, every trader's got a different trading style. So it depends on how you feel comfortable with. Are you a swing trader, intraday trader? Are you a scalper? It's all up to you. So you need to get that feel in the market. Every trader is different. But let's start off on a daily time frame. So daily time frame, you can see this your little trend going upwards, okay, in the market. So you have that movement going up. Okay, that's basically the first one. Right, and the second one, you have a downtrend that formed. Okay, I'm not going to go into the whole trend line, how to draw it again this weekend. We did talk about it last weekend. So that is basically, let's just have a look there. And then we do that just to get it perfect. And that, I like all my stuff being very nice. Okay, so you can see that wedge being formed in the market. So you have a downtrend and uptrend. So we're obviously looking for any type of break of structure. Okay, let's just, I actually do not know where my tool is that I'm looking for, but we need a break of that, and then coming down and then going up. You know, that's the norm of when these wedges or stuff forms. Or you need a break at the bottom, you need and then a retracement, and then a carry on to the downside. So we'll have to see to where and what price is going to be doing, you know, going on a high time frame. Let's drill down to our 4 hour again. 4 hour, just zooming in. Excuse me. So again, we have got this gap that was formed in the market by open, okay? But we will talk about that gap on an hourly time frame. But what I want to show you now is a little Fibonacci. So you have a Fibonacci, or, you know, little entry. It's going up. I just want to see. This is not the right one that I'm looking for. Yes, it is. So you have your little first entry, okay? Right about there. Okay, that's it. So first entry, swing low, swing high, retracement to the 62%. So you could have caught a nice little buy upwards. Okay, that's a nice little upwards buy all the way to there, to the top. Oops, excuse me. To the top there. Nice little entry. Or you could have had we're looking at this entry here. So you have a bigger one. Swing high, swing low, swing high. Swing low, swing high, price going back down into the 62% area. Look at this. Okay, so again, if you waited for that one, you could have entered right here, and you would have, if you were still holding 177 pips in profit, if you are buying. That is more for the swing traders. Okay, so let's do the 1 hour time frame. Let's drill down. Let's have a look at what happened this week, and then we can see what we're going to be looking at this coming week. So this week, a couple of things that happened in this currency pair. So I want you to focus a little bit. So let's have a look. So we have got the area that I marked out in the market for you know, last week, the end of last week. Then we saw price opening with a nice little gap. All right. So let's have a look here. We have got this gap in the market. So what happens is price gets drawn to that gap. Okay, that is always the area price will get drawn towards. Now, so you highlight that price or that area in the market out. Now, be in mind, this obviously that hasn't happened yet in the week. So you highlight that area off, or you just highlight it in the market. You know the price gets drawn to those areas. So now you focus on what's happening. So the price goes up, it breaks that area. Now it comes to the top with a nice bullish candle. It makes a downwards movement and a retracement. It is as simple as that. Downwards movement with a retracement. So how do you calculate your retracement? From the top to the bottom, easy. Swing high, swing low, retracement, 62%. That's it. That's your first entry. Okay, easy little entry. And what happens is you hold that entry. Okay, because you want to see price going to the gap, or it needs to fill that gap. So if you entered there, you would have had a nice little, almost 200 pip plus sell opportunity. Okay, that's your first area in the market that you target. I'll show you a second one just now. So let's say you missed that area or that entry in the market, then you wait for your second one. If you missed that one, you wait for the second entry. Or if you are in this entry, if you are in this sell and you want another opportunity, this is the other opportunity that you could have gotten. Again, swing high, swing low, retracement, Perfect entry, 62% price touching that area, as you can see. Just zooming in, there we go. Candle touching that area, not a lot of drawdown in the market with that. And then you could have had price, you're selling off there. That's your first target, is your, the price gets filled, or that gap gets filled in the market, and that's another 155 pips. Let's say that's your first entry, it's 155 pips. Let's say that's your second entry, and you just add it to your previous one. So I mean, with only these two currency pairs that we're just talking about, it's over 600 pips already in 1 week. So guys, patience. You don't have to be in every single trade, but just little moves like that, okay, gives you a nice little amount of pips, you know, just on two currency pairs. Now, I wanted to show you now. So you have your first target in the market. You see price going up again and then down. Why is price going down even more? Why is that a fact? Why does that happen? It gets drawn to it something. What does it get drawn? What does price get drawn to it? Look at that. Structure being broken when price went up. If you just look to the left, what happened was price created an imbalance in the market, or that candle created an imbalance. It created a fair value gap in the market. That fair value gap has not been filled yet, basically. Price has not come back towards that. Came close, then it shot up. Then eventually, look at this. You draw to the side, look at that, bam. That's it, okay? It's nothing, it's not like, wow, it's genius and all that. It just happens every single time. It's not a case of fair value gap gets created, price, you know, once it makes a turn, it will come and retrace towards that. It will take time, okay? There's a lot of times that it happens straight away, a lot of times that it takes a week or so to get to that. And as you can see, price going up, that's your first target, that gap in the market, you know, second target. If you saw that gap or that area being broken, where does it get retraced to, or where does it pull towards? It pulled towards the second fair value gap, the second area in the market, that imbalance. Price gets drawn towards that area. So again, you could have held your trade all the way from the top. Let's say you ended over there, your first entry, move down. That's 300 pips again. So guys, just be patient in the market and always remember to look towards your left. Keep these areas, these imbalances in the market, highlight them out, okay? If one happens, highlight it out and just move it to the side. Just draw that area to the side. Keep those areas in the market, because price will get drawn towards those areas. It's as simple as that. Use your Fibonacci for your entries, use your fair value gaps for your entries and your exit, and you will start making pips. So that's all from my side. I hope you enjoyed this analysis. If you did, please do not forget to hit that like button. Show me some love by pressing on that super thanks. Subscribe to my channel, hit that notification bell. There's definitely more videos coming your way. So guys, I hope you've been having a fabulous weekend. Stay safe and happy trading, guys.